Okay, so health savings accounts, and those of you, and most of you have taken payroll accounting, probably remember us talking a little bit about health savings accounts. Health savings accounts are a particular type of savings account that has to be paired with a particular type of health insurance. So, and it's the health insurance that has to be paired with is called a high deductible health plan. So HSA, that's our health savings account, has to be paired with a high deductible health plan, HDHP. The federal government determines whether or not the health plan meets that criteria of being considered a high deductible health plan. There are, I think they've got it in here, I'll come back to that in just a second. So and this changes every year. So there are limitations on the deductible and the out-of-pocket maximums. Out-of-pocket maximum is the maximum amount that the insured has to pay out of pocket. Now this is on an annual basis. Usually once an individual reaches their deductible, so that's when they have a health insurance, or when they have a health, they need to use health care, medical expense. The first amounts that are paid will go toward the deductible. So you still, even though you've got the health insurance, you're still gonna have to pay the first amount in the form of a deductible. So if you've got a $10,000 medical expense and your deductible is $1,500, you've gotta pay $1,500 before the insurance starts to kick in. Usually after that point, after the deductible is met, there's what's called co-insurance. So after that point, the health insurance company will pay a percentage of your expenses. So maybe they'll pay 90% of everything after that first $1,500. So if it's a $10,000 expense, we're paying the health insurance, we're paying $1,500, there's $8,500 left, we still have to pay 10% or $850 of that $8,500. So that goes on and on and on until you meet what is called the out-of-pocket maximum. After that, the health insurance company pays for everything. The high deductible health plans have to meet these criteria. So the deductible, the smallest amount of deductible has to be either $1,500 for individual coverage or $3,000 for family coverage. And then the out-of-pocket maximum has to be either $7,500 for individuals, $15,000 for families. Still a lot of money, and remember this is only on an annual basis. I mean, this is on an annual basis, this isn't lifetime. So that's a lot of cash to have to come up with when you've got this high deductible health plan. So what they did was they developed these health savings accounts that allowed individuals to put money aside to help pay for those expenses. So now when you've got your $1,500 deductible that you've got to pay, and then your $850 of co-insurance, if you've got money in a health savings account, you can just draw it from that. So the benefit of the health savings accounts is you do not, the amounts that you contribute to a health savings account are not taxable. Meaning that if you contribute, say through an employer, so you're in your paycheck every month, you have the employer set aside $200 that then goes to your health savings account, that $200 reduces your taxable income. So you're not paying tax on that. If you don't have an employer, you've got a private health savings account, which you're just paying for it out of pocket. Now you get an adjustment to your adjusted gross income in the amount of the health savings account contribution. So it's to encourage people to contribute to these health savings accounts. So we've got these, this pertains to the health insurance benefits. Okay, has nothing to do with the premiums. We're not talking about premiums. And by the way, you cannot pay for premiums out of a health savings account. Only medical expenses can you pay for out of a health savings account. But the health savings account never disappears. It's yours. It belongs to the individual. So if you change employers, you get to take it with you. A lot of people will, especially a lot of wealthier people, will have health savings accounts, and they'll contribute to it because they can also, once during your lifetime, you can roll it over into an IRA. These are people who made too much money to contribute to an IRA. They were outside. IRAs have phase-out ranges as well. They were outside of the phase-out range. Well, this is an additional way. They never intend to use that money for medical expenses. They use it as a savings vehicle. And when it's in that, you can make investments. It can be like a brokerage account. You can invest in stocks and bonds and all sorts of things through your HSA. So they see it as an additional savings vehicle that then ultimately they can roll over into a retirement fund, whereas they weren't able to contribute to the IRA all along. They're going to contribute to the HSA and then turn that into an IRA ultimately. So they're oftentimes used for other purposes as well. There are also maximums for the amount that you can contribute every year to an HSA. So if single individuals up to age 55 can contribute up to $3,850. Families, as long as the contributor is under age 55, can contribute up to $7,750. So this is all tax. It's a tax benefit. So you're not having that amount. If you contribute that amount, it's not being taxed. It's reducing your taxable income. If you are over 55, you can contribute an additional $1,000. And let's see, if the taxpayer is 55 or over, they can contribute an additional $1,000. If both spouses have only coverage, each spouse can contribute up to $3,850 into separate accounts, and if they're over 55, they can each contribute an additional $1,000. Now, you can only use the funds in that HSA for medical expenses without there being a penalty. And the penalty is 20% on any amounts that are withdrawn that are not used for medical expenses. Now, the list of medical expenses is pretty broad as well that you can use it for. So ordinary things like doctor's visits, but glasses, dental, prosthetics, orthotics, medications, chiropractic, some naturopaths as well, that kind of thing can be used. You can use those HSA funds for that. But it has to be for qualified medical expenses. Let's see. All those funds are exempt from tax, and it grows exempt from tax. So if you use it as a savings vehicle, as an investment vehicle, that money grows and you don't pay tax on it until you draw it out, right? And as long as you either use it for medical expenses or ultimately roll it over into an IRA, in which case, if you do that, then you can pull it out for retirement income. In that case, there's no penalty for it. So the HSA form that is used. So every year, somebody who has an HSA gets this form, this 1099-SA. It shows, this is just for distributions, amounts that were taken out of the HSA. So the gross distribution would be there. But there's another form, the 5498, which shows contributions. So any amounts put into an HSA would be reported on this form at the end and sent out at the end of the year. So those are used when preparing tax returns as well to help substantiate. Now sometimes these 5498s don't actually go out in the mail until like May. So most times, and if it's through an employer, that amount of contribution will be listed on the W-2. Okay. But if it was a separate contribution, like it was an individual that contributed it, oftentimes what you need to do is get that information from the individual. How much did you contribute? You know, show me a bank statement, that sort of thing. Because many times you won't have this yet. And then, so those are the forms where the distributions and contributions are reported. the form that is used, that is attached to the 1040, if there was any contribution made or if there was any distribution made, is this form 8889. And this is where you indicate whether it's self-only or family coverage, contributions that were made but do not include employer contributions, because that's going to be on the W-2. Okay, so we're not going to include those here. This first part is for contributions, and it's the calculation of how much you contributed and how much you were allowed to contribute. This then becomes ultimately the HSA deduction, which flows through to Schedule 1, Part 2, line 13, what we just looked at there. So Part 2 of the Schedule 1. And then the bottom part here, Part 2, is for distributions, amounts that were taken out of the HSA. You have to indicate how much was taken out and how much you had in medical expenses. How much of what you took out was actually for medical expenses. If you took out more than what was for medical expenses, then you're going to have a penalty. That 20% penalty is going to apply, and it will be calculated here, this additional 20% tax. If not, if they're equal, no problem. If you had more medical expenses than your distributions, no problem. No additional tax on that. All right, and then there's this, we're not really going to go through too much of this. If you contributed to an HSA but you weren't qualified to do so because you didn't maintain a high deductible health plan, this last part is, that's what this part is for. All right, questions about HSAs? Different from FSAs. FSAs are flex savings accounts. Flex savings accounts, there are flex savings accounts for medical expenses as well. The difference between the two is that with an HSA, you keep it always, it never goes away, you never lose it. With a flex savings account, if you do not use the funds that are in that flex savings account during the year, it goes away. They remove the funds. So you don't want to contribute more than what you actually need. Both of them are tax advantaged. You can contribute more to an HSA. For an FSA, I think the limit is about $3,000, something along those lines. But for an FSA, you don't have to have that high deductible health plan. You can have any kind of insurance. You can have no insurance, doesn't really matter. But it's always through, those FSAs are always through a cafeteria plan through your employer. Okay.
I have a quick question.
Yeah.
So for Part 2 with the distributions, you were saying if you were self-employed or you self-paid, you would get these other two forms like in May or something. And they do have the distributions on one of those forms.
Well, this one would come out, the distributions would actually come out. This one would come out
Everyone gets that?
early.
Even your employer?
Yes. If you took money out of your HSA during the year, you will get this 1099.
Does that mean you take money out in any other way besides just using your card at the counter or using it?
Any type of distribution. So if you rolled it over to another one, which you can do, you would get a distribution form. But there would be a distribution code saying that it was a rollover. Do you have a specific scenario?
We have an HSA account and we use the card all year and I don't recall ever getting one of those.
Oh, you should be getting one of these.
So I'm gonna go home and look at our back taxes and see.
Yeah, whoever administers it is supposed to send that out so that you know how much was distributed. Yep. Other questions?